So, what if I told you that a major war breaking out could actually be good for the stock market? It sounds totally backward, right? But that is exactly what happened in a recent crisis. And it really flips the script on everything we thought we knew about how markets react to huge global events.
Just imagine it. You wake up, you see the headlines, a new war has started. Your first instinct, probably like most people, is to check your stock portfolio, fully expecting to see a sea of red. Panic selling, prices plummeting, that's the textbook reaction, isn't it?
Well, this time, the textbook was just plain wrong. The stock market didn't just hold steady. No, it soared. A pretty stunning reversal that left a lot of investors scratching their heads, completely baffled. And listen, this wasn't some minor border skirmish. On February 28th, 2026, you had smoke rising over Tehran. This was front-page news across the entire globe. And yet somehow, Wall Street seemed to be living in a completely different reality. How is that even possible?
Okay, so that brings us right to our first section. We really need to unpack this paradox by looking at exactly what happened and when it all went down. What kicked off as internal protests back in late 2025 started to spiral, and fast. By January 2026, we saw a violent crackdown and then a direct threat of military action from the US president. And then, boom, on February 28th, that threat became a reality, with coordinated military strikes. The situation was escalating at a really alarming pace. And on the very day the strikes were launched, the market didn't just ignore the news, it celebrated. The Dow Jones shot up over 500 points. The S&P 500 was up over 1%, and the Nasdaq, it led the whole pack with a gain of almost 1.5%. This was not a market bracing for impact. It was a market, as one analyst put it, putting a rocket under stocks.
Which leads us to the million-dollar question. Why? Why in the world did the market react with a rally instead of a retreat? All right, let's break it down.
Okay, so a big piece of the puzzle comes from research by economist Diana Musina, who looked at a century of data. And what she found really gets to the heart of it. While markets do dip right after these geopolitical shocks, they tend to bounce back surprisingly fast, often within a year. It's almost as if investors, and maybe the algorithms doing a lot of the trading, have seen this movie before and they know how it usually ends. So what's really behind this resilience? Well, it pretty much boils down to three things. First, there's this sense of familiarity. Investors have gotten kind of desensitized, and they tend to wait and see if a conflict is actually going to hurt global growth before they really panic. Second, and this is a total game changer, is U.S. energy independence. Unlike the oil crises of the past, the U.S. is a major oil producer itself now. And third, there's this deep-seated belief in central bank support. Investors are basically betting that if things get really bad, the central banks will step in to prop up the economy. But here's where it gets really interesting. The calm in the stock market was actually hiding a much more turbulent story. Under the surface, a totally different drama was playing out between different kinds of assets. We saw a classic flight to safety, but with a very modern twist. Money flooded into traditional safe havens like gold and silver, which saw some big gains. But at the exact same time, investors were fleeing from riskier assets. Bitcoin plunged, and other major cryptos followed right behind it, acting a lot more like volatile tech stocks than the digital gold some had claimed them to be. For years, this whole narrative had been building around Bitcoin as digital gold, a safe haven that would hold its value when things got crazy. But as Deutsche Bank analyst Marion Labouré pointed out, this crisis really just shattered that idea. When push came to shove, investors treated Bitcoin not as a safe store of value, but as just another high-risk tech bet. But the real drama, the one that truly had the entire global economy on the edge of its seat, was happening in a totally different market. The one that always sits at the intersection of geopolitics and your wallet: oil. Get this, before the stock markets even opened on Monday, the price of Brent crude oil had already jumped to $72.48 a barrel. That was a nearly 2.5% jump before the first strikes were even launched. Traders weren't waiting around. They were already scrambling to protect themselves.
So why all the panic about oil? Well, the answer lies in one of the most important and fragile geographical locations on the entire planet. This right here is the Strait of Hormuz. At its narrowest, it's only about 20 miles wide. But this tiny stretch of water is basically the most critical artery for the entire global economy. And it sits right on Iran's doorstep. A full quarter, 25% of the world's daily oil transport passes right through this tiny strait. Let that sink in for a second. 1 out of every 4 barrels of oil consumed on the planet goes through here. That adds up to 20 million barrels of oil every single day. So any disruption here isn't just a regional problem, it sends massive shockwaves across the entire globe. And the risk here is just enormous. Analysts at Barclays were forecasting prices hitting $80 a barrel with just a minor disruption. But the worst-case scenario, a full shutdown of the strait, some were predicting oil prices soaring past $130 a barrel. A shock like that would be, well, absolutely catastrophic for the global economy. Okay, so what does all of this mean for us? For you and me? How does all this high-stakes geopolitical chess actually translate into our daily lives? This whole crisis really offers 4 key takeaways. First off, stock investors have learned to look past the initial headlines of a lot of these conflicts. Second, that flight to safety is definitely real, but the very definition of a safe asset is being seriously tested, especially with crypto. Third, oil is and will continue to be the ultimate geopolitical wildcard. And finally, for most long-term investors, the fundamentals, things like economic growth and inflation, still matter more than these short-term flare-ups. Which leaves us with this one last thought. Markets have proven to be incredibly resilient to geopolitical shocks. They absorb the news, they reprice the risk, and then they just move on. But that resilience isn't infinite. It really makes you wonder, what's the next crisis, the true black swan event that finally becomes the breaking point?